Okay, I think we're, good morning, everyone. Continued good morning. I hope you've enjoyed the morning session so far. I think it was some fabulous conversations behind me here next door, depending on how you look at it. My name is John Tuttle. I'm part of the technology to market team here at ARPA-E. At its most fundamental level, our job in the technology to market is to assure or provide for the highest probability of success of our projects in the marketplace. And of course, inevitably, in most cases, after a project finishes with us, they require additional capital. That capital can come from other government agencies, but in many cases, it has to come from the private sector, one way or another. And so on the one hand, over the past, say, 5 years, there have been some challenging statistics about how money is flowing into the energy sector. On the other hand, we are starting to see some very interesting new trends, new players. And so the purpose of today's panel discussion here is to dig into some of these trends and to have a conversation that will hopefully stimulate further conversations in the hallways and provide some both insights as well as some optimism about where all this is going. I'm going to just briefly introduce the moderator for the panel. He'll then in turn provide some quick introductions. We'll have the panelists sort of introduce themselves. Just a reminder, if you haven't seen or heard this already, where to go. There's instructions for texting questions up to the moderator. There we go. And that's how we do that here. So today we're very fortunate to have with us Mr. John J. MacWilliams. He was appointed August of last year as an Associate Deputy Secretary of the U.S. Department of Energy. He also serves as the department's Chief Risk Officer and advances secretarial priorities of enterprise-wide approaches to innovative finance, risk management, project management, nuclear and cybersecurity. But before his present work in the department, he had a very long, stellar career in fact, the investment business in the energy sector. And so please provide a warm welcome for John MacWilliams, our moderator.
Thank you. Thank you very much. Good morning. I first of all want to apologize for my voice. I've got a bit of a cold. I just got off a red eye, so I've, as many of you, I've probably done just the same thing. So we've got a great panel this morning because we have different segments of the investment community here, and I'm going to let each of the panelists introduce themselves as we go forward into questions. And really what I hope to do today is to make this very interactive, so fire your questions off, and theoretically they're going to show up right here, and we'll answer that. Let me just take a second to give you sort of my background and vantage point. I've been at the department coming up on 3 years now with the secretary, and as was mentioned, I have a private investment background. Primarily, I've been investing in and around energy, very broadly defined, since about the mid-'80s. Now, of course, I'm doing a wide variety of things in the department, including clean energy finance. So when I was investing, I think we had 30, 35 companies, about a dozen of which were clean energy technology companies. And as you all know, it's been pretty difficult over the last couple decades to make money on a sustained basis in this area. And so, one of the questions to look at is why that's the case. I must admit, maybe it's now that I've been here a few years and I'm drinking our own Kool-Aid. I personally am really persuaded that, and I wasn't here, but I understand Vice President Gore made a similar point this morning. I think we will look back and realize that we're at a point of major transformation and really potentially a paradigm shift. Obviously, the energy sector in general is undergoing significant transformation with increasing supplies on the traditional side here, particularly here in the States. The cost of various technologies coming down very dramatically, particularly over the last few years. And so there is a lot going on. And I think we'll look back and realize this was a real opportunity. At the department, as you're all aware, we are very significant contributors to investment in early stage technology, whether it's through ARPA-E, EERE grants, the Loan Program Office, which Peter used to run until recently, our 17 national labs, which are really national treasures. We've recently stood up a Clean Energy Investment Center, which Sanjeev, standing over here, is heading up. And our Office of Technology Transitions, which Jetta, most of you probably know, runs as well. So we have a major presence as a department and as a government in stimulating investment in this area. But having said that, as you all know, we've seen significant fall off in traditional early stage investment right at a time where we need capital. And you've all seen probably the IEA projection that we're going to need $44 trillion between now and 2050 if we're going to have even an 80% chance of meeting our climate goals. We've seen COP21, really a success there and a lot of energy coming out of that. But I guess I would start off with the question is, having been an investor most of my career, I don't know many fiduciaries who knowingly want to lose money. And therefore, the question really is, we know there's plenty of capital in the world, but is there an investment proposition here that makes sense? Is there a viable investment proposition or propositions? And so maybe we'll just start with that, and I'll let each of you introduce yourself, and then also maybe tackle that, and then we'll go on to other questions. Okay. Please, Mike.
You want me to go first?
Sure.
Okay.
Thank you.
So just again, for some perspective on where I'm coming from with my comments, I'll give you a snippet of my background. And I think I'm on the stage today because I've spent a lot of my career in various ecosystems represented here at the summit as we try to build a more innovative climate for energy and I would say resource going forward and more sustainable businesses. I started at Dow and GE. I worked the first third of my career at big corporates. I then decided I wanted to try to build an entrepreneurial company, and about 22 years ago, against all the best advice of my managers at the time, I struck out on my own and I built a company literally from my garage to what's now a multinational leader in its space. Raised about $160 million from investors over that time period from every flavor of investor you could imagine, and over $50 million of debt to finance a big infrastructure play. So I was one of the clean tech companies that was building the brick and mortars, the hard road, and went through many, many valleys of death and somehow managed to crawl out the other side each time and build a stronger company each time. That company is now doing well, standing on its own. So about 3 years ago, I told my board I wanted to go out and try to reproduce what I had done at that company and help other clean tech companies in a wider variety of sectors. And I started doing that, coaching and looking at angel investing, and then stumbled across a colleague of mine who was starting a new fund in this space. So I think that's the other reason I'm up here, is I think we probably have the newest clean tech fund. It was just announced in December. It's a $100 million fund focused on the clean energy sector. Our first funders, our seed funders, are from the oil and gas companies in Canada, namely Suncor and Cenovus. The name of the fund is Evok Innovations. You can go to our website and check us out. It was announced in December. And just since December, we've already looked at over 100 deals in this space. And besides being a new clean tech fund, and we're going to come back to your question, can you make money in this space? Besides being one of the newer funds, if not the newest in this space, our focus is on early stage companies. And I think many of us know or feel, that are particularly your entrepreneurs in the room that are looking for money, feel that the investors have fled the early stage space, particularly the traditional venture capital investors. And I think there's a lot of truth to that. I think a lot of them have, and they've moved into later stage. And two more comments before I finally answer your question. So when I was raising money, which was 17 years ago when I first started raising money for my startup, there was no clean tech was not a word, sustainability was not a word, at least not used in the context we use it today. Our company was pegged, even though I thought we were a resource efficiency play, our company was pegged as an environmental company, which to investors meant you were automatically going to lose money. And what was hot in those days was .com. And so every investor I went to said, well, if you don't have a .com after your name, we're not going to invest in you. Well, long story short, I managed to convince investing in brick and mortars was a good idea, and it did pay off, I think, for my investors. So, but it was a long, hard battle. So people today say, well, it's even harder. It's harder because all the VCs have left this early stage space. And I would echo what Al Gore said, and actually what the Atlantic article that was referred to earlier pointed out, is that his generation fund is apparently ranked #2 in the world in returns. So there is money to be made in this space. And I tweeted that during Al Gore's talk. And one of the tweets I got back was, yes, but not if you're an early stage company. There's no money for early stage companies. So I think that's really the conundrum we're under. I think there is funding for well-proven technologies that are efficient, that are resource efficient, and I think there always has been. And somehow I managed to get to that point and was able to get additional, bigger scale funding with my company. And I think that's where the companies today are struggling, is how to show that they are economically efficient and not just resource efficient. So one of the things our fund does at Evok is to invest in those early stage funds. Back when I was trying to raise money, there was no ARPA-E funding. This is new. There were angel investors were there, but they were very few and far in between, and they were also mostly in the tech sector. Now you see angel investors that get it. They want to invest for good. They want to invest for the future. And they really understand the space, and they're backfilling a lot of the space left vacant by the VCs. We have a lot of other government funds. We have crowdfunding, and I think we're going to maybe talk about that later. So there's a lot of sources that were simply not even available to me when I was raising money. And as we know, we have this $44 trillion probably investment, I think it's probably even more, to fill in order to deliver the world that we want our children to inherit. So we have a big job in front of us, but we have more resources available to us, I think, to fill that job. That's the good news. The bad news for you as entrepreneurs, good news for me as an investor, there's more deals than ever in this space. As I said, we've already in 3 months looked at over 100 deals. And we're just scratching the surface. That's good.
Yeah, that's deal flow is something I'm going to talk about in a few minutes. Yeah. I'm interested in perspectives. Pulakesh, I know, in the past, strategic investors have played a really important role in sort of bridging sometimes from the very, very early stage to the later rounds. And so I'd be interested in your perspectives. And why don't you give us a little bit of your background as
Sure.
well.
And I'll talk about how we do it at BSA Venture Capital as well. So by training, I'm a chemist, and started in BASF in the R&D. And after a couple of years and doing a production in the meantime, within BASF, I shifted to the operations side, was responsible for business development and later on marketing and sales. And as of 2009, responsible for BSA Venture Capital in US and Canada. And coming to your question, addressing that whether there's money to be made, let's address how we do it. So BSA Venture Capital, we are in existence for the last 15 years. It is a corporate venture capital, but a separate legal entity. So in principle, we have one LP, and the fund comes from BASF. And we look at anything where the innovation is related to chemistry and material. So a lot of the sectors of energy, be it storage and others, and BASF being a very broad company goes from oil and gas to agriculture and everything in between. So when we look at investment, we have basically two goals. First, being a corporate VC, we look at the strategic fit. What that means to us is, obviously, where is the interest for BASF? But also, we are very careful in saying, what will BASF Venture or BASF bring to the table other than money? So when I'm talking to a startup company, one of the questions I have is, so what do you expect from BASF? Because if it is just only money, there are better sources to get money. And most corporate VCs will say we bring resource to the table other than money. It is easier said than done. Most of my work is going to manage to BASF and how can we bring that resource. So we try to address that early on, and then we look at, obviously we are not in the business of losing money. Yes, I hear that a couple of times that, oh, you're a strategic investor, so return is not important. When we go to an investment board, I cannot say, oh, this is a technology which will change the world. By the way, we will not make money. That doesn't make sense. Secondly, we always invest with other syndicate partners, and we take board seats. So when we are sitting on a board, and you are sitting on the board having a return expectation of 2 years, 50% IRR, and I can sit on the board and say, 15 years, no return, that's a dysfunctional board. So when we invest, we make sure that we are aligned with the other investors, and then we go forward to it. So that's a very brief introduction, and coming to a question, I strongly believe there is money to be made. If you look at each sector, the standard question that a lot of the VCs ask is there a market? If you make it, will they take it? Actually, those are irrelevant questions in this space. These are not billion-dollar markets, it's a trillion-dollar market. The challenge is it's not easy. So a question to be asked is not whether to be money, it is what's the right model and how to make the money in this space. And when is it a right time to form the company? A lot of the hard science of material chemistry takes 20 years to bring it to the market. So when is it a right time to form the company? When it should stay in the lab and when it should get incubated? That, I think, is a question, and then you'll see how to make the money.
Good, thank you. Over the last couple of years at the department, one of the things we've been looking at is, are there new types of investors, a new class of investors that might be able to participate in this space? And so starting back in, I think it was April of 2014, we started a series of roundtables. Some of you, I think, were at some of our roundtables. We started here in Washington and then went out to Silicon Valley and met with investors there. Also did one in New York, and culminating in a White House investment summit at the end of last year. Really looking at whether other types of investors, whether it be family office or foundations or new coalitions of investors who might have slightly different investment profiles and needs, might be able to fill this bridging gap between the most early stage companies and then a little bit later rounds when we would typically see traditional private equity and VC investors. Peter, who's a good friend who we spent a lot of time together at the department, as you know, ran the loan program office. You know, he's sort of like Victor Khayyam. He liked the idea so much he voted with his feet, and now he's running this new enterprise aligned intermediary. So, Peter, maybe you should tell us a little bit about that, and then your perspective about this fundamental question of how you approach, because as a fiduciary, obviously, you're trying to figure out how to make money and still make these types of investments.
Okay, so great. So very nice to be here. Thanks, John. Whenever John wants me to do anything, I just follow.
Oh, yeah, sure. Right. Yeah. Don't buy a bridge from him.
So I was, you know, one of the nice things, if you're a scientist, you can always say I was trained as a scientist. I'm a scientist. If you're not a scientist, I mean, what do you say? Like, I was a businessman, trained as a businessman. So I guess that's what I am, and I was trained at. And so I worked at Morgan Stanley for a while, and then I was very involved in funding a number of companies. But relevant to this, I ran economic development for New York State for a couple of years, and were very involved in deploying regional portfolio standards, all ways we tried to figure out how you create the demand that makes big construction projects and energy happen. And then after that, joined the Department of Energy. We ran the loan program office, and we can talk also a little bit about how that was an absolutely fundamental catalyst to demonstrate technology at scale, prove that technology out to equity investors, so that they became comfortable that technology and new processes worked. And once they saw it demonstrated at scale, then hopefully they'd be more likely to invest, which is actually what the fact pattern was. And then this latest venture, which I'll talk about briefly, is called the Aligned Intermediary. And as John mentioned, that was 6 institutions that came together at the White House, really organized by John and others. And it was people who made a commitment saying, look, we understand we need to raise that $1 billion in order to have this chance to stay under 2 degrees centigrade. And we're willing to do it, but we are not willing to take a dime less of return than what we would normally do. So we're making a commitment, but you have to show us a path to how to get that done. So that first process had to be organized, an entity was created, that's the Aligned Intermediary, and that's what I'm now the CEO of. What's very interesting about that, and I'll just make this one brief story and then we'll go to the questions, is these are big institutions: University of California Regents, TIAA-CREF, New Zealand Super Fund, Wellcome Trust, big multi-billion-dollar institutions that want to get into this space. And you would think, you're some of the biggest financial institutions in the world. You can do what any type of investing you want to do. And what became interesting was they normally do their investing through funds, and they'd invested a lot through early funds. And the early funds 10 years ago that were looking at this space, the energy space, for whatever reason, were energy tech funds. So they all did tech investments. They did solar panels. They did technology investments. And energy is not necessarily technology, but all the money that was raised from these big institutional investors was tech-related. So when tech did well, it did well. And when tech crashed, which tech did, all of these funds generated very bad returns. And all the big investors, CalSTRS, New York State Common, they all came into these funds, committed over $1 billion. Now, 8-9 years later, when they look back on the track record, they are across the boards unhappy with the performance results from those funds. That's where there's an opportunity for new funds to get into the space, but the historic ones didn't do well. So these investors now do not want to participate in other funds that do clean tech, because in their mind it's clean tech. However, had they decided to invest 5 or 6 years ago, not on the technology side of energy, but on the deployment side of energy, they would have had very strong returns. And because some of the deployment companies in wind and solar, those investments have been very successful. So what these institutions have really come to us with the proposition is to saying, we know there are positive ways to invest money to make a return, but we need to find what those are. We're not finding funds that we can invest in. We also need to invest a minimum of $1 billion into a program. So if someone has a venture fund, this is the way funds work. No fund wants to be more than 10 or 20% of a fund. So Michael's fund is maybe raising $100 million. University of California Regents couldn't invest more than $10 million in that. Their minimum investment in any one transaction is $100 million. So they can't come into a fund unless it's $1 billion fund, 10% of $1 billion being $100 million. So instead they're saying we want to start making direct investments in energy efficiency, water infrastructure, all these type of assets. And so that's the process we're going out to do. And our fundamental belief is there are many, many companies, many opportunities to make money. When you look at our investors, those with their type of capital they have to commit, it's a very different risk profile than doing venture investing. It's really deployment investing. But we feel that's all part of the struggle because we have to mobilize that additional $500, $600, $700 billion per year. And just the last thing is if you look at where the money is in the world, you put all the money that exists in venture capital funds, put all the money that exists in private equity funds, you even put all the money that exists around the world in energy and energy efficient companies publicly traded, that number is dwarfed by the number that sits on the balance sheets of pension funds, insurance companies, endowments. And those are the people that have to start investing. And those are the investors we have to start creating products that can make it an easily investable decision for them.
So I think that's right on point. Let me mention that your questions are starting to fire in here, so I'll start intermixing those. And also, let me remind you that if you could, you've got to limit your questions to, I think, 166 characters or whatever, 160 characters. So we'll turn to some of these questions, but let me also, as you maybe answer some of these questions, maybe you could weave in an answer to the following. Since, this is a fairly technical crowd here, and so I'd like to really drill down a little bit because we always hear, okay, there's investment opportunities, deal flow, but if you're sitting there and you're managing money and you've got an IRR clock and you've got a preferred return, whatever, 6-8%, eating away at your investment. So as a GP, and you have longer investment cycles, particularly in investments where the utility sector is involved, a long capital intensive cycle. So these are the kinds of things, I think, that very, very fine venture firms in the past have found difficult. And so either our new investors are smarter than the old investors, which is probably a dangerous assumption. At least I would not necessarily assume that. Or there are different structures, different ways of looking at investments, maybe different approaches to duration, maybe different fund requirements. And so those are the things, if you can kind of weave those thoughts in. But let me turn to a couple of these questions. I guess, Mike, a couple questions came in for you in terms of what your definition of early stage is. And then also, are you primarily investing for the traditional oil and gas sector? So those were...
Both good questions. And I will weave it into your question, which is also a very good one, or your point. Excuse me. And I think your point is why we've seen a lot of the traditional VC investors move to later stage, because they couldn't get the numbers that Pulakesh mentioned work. They don't work with early stage investments that take 10 years of maturation to get to commercialization or more in many cases, as my company was an example of. So, so I think a new model is required, and that's one of the reasons I joined Evok, because it is a new model. So I'll tell you a little bit about Evok, since that's what the questions are. So for one thing, this will be a little strange, we're a nonprofit. And number two, we're measured first on the impact our investments make on the environmental metrics, not on financial metrics. Of course we care about, just like Pulakesh said, we care about getting a return. And partly the reason we care about getting a return, because if a company's not viable, if it's not economically sustainable, it's not going to deliver on its environmental sustainable promise, right? So you have to have economically sustainable, whether you're an investor or not, because these companies have to survive and they have to thrive, not just survive. But our first metric, I'm a managing director, and my first metric is on, do the companies that we invested in, have they delivered on the CO2 conversion promise that they said they would, and how big is that? And we're designing our bonuses instead of carry around that. So I think that's a huge difference on what motivates me to pick the companies that I invest in as an investor, much different than a traditional VC. So that's part of the way, that's part of the way we change the model. The other question I think referred to how do we define early stage? Well, we're still trying to figure that out. We're a startup, but early stage is pretty early stage. We'll even create a company if necessary. If we see a technology out of a university, for example, that we think can solve a problem like CO2 conversion, we're willing to invest in that technology. And one of the reasons Evok brought me on board is I'm the operating guy. So I will go in and coach and help companies build the teams out. That's the reason I'm there, and that's the reason I want to be there, is because I want to help these companies thrive and build strong teams.
Great. Pulakesh, question for you that came in. We certainly in the Department of Energy and elsewhere in the administration are really constantly looking at ways that we can help and can aid, whether it's setting up the Clean Energy Investment Center, as we talked about, because many investors in our roundtables told us that access, obviously we can't offer preferred access, but general access to our national lab systems and all the various technologies and expertise that we have could be very helpful for people. So that's one of the things that Sanjeev is going to be working at, interfacing. But a question for you is, obviously you have a lot of resources at BASF, and what resources or venues, particularly at ARPA-E, for example, have you used or have you been able to use to help you fill out your deal flow and progress your investing?
So in this regard, if you look, BASF is a chemistry material company. And if you look at the programs that ARPA-E run, and I don't know what the present number is of different programs, maybe 20, close to 20 with all the acronyms, I would say 80% of them have material play. So when we were looking at new magnets, so one of the first places I start was the magnet program that ARPA-E had. I forgot the acronym. And there were 14 companies which were funded or university work. So that gave us the basis of building up on that. So a lot of what ARPA-E does actually fits very well to BASF, because most of them are hard sciences, which has innovation, be it energy storage in material, chemistry, and that fits absolutely perfectly. Coming to national lab, within BASF presently we have a huge group, more than 200 people working on cathode material. The basic license we took was from Margaret National Lab on the layered structure of lithium cathode. So these are just two examples. And when I look at innovation within BASF, the venture part is a small part of the overall thing. So we have more than 5,000 collaboration all over the world in the university stage. Then we have the venture where we are not doing it ourselves but partnering. Then the business unit does joint development with university and other companies. And finally, there is acquisition. So it's a continuum of space. And what we occupy is a small slice of the overall space.
Great. Peter, a question came in about whether there are opportunities for universities to invest their endowments, and maybe from your new vantage point, you might want to address that. Or other, you mentioned the pension funds, and I absolutely agree with you that what we really need to see is we need to unlock the capital. I mean, that's, why does Willie Sutton rob banks? Because that's where the money is. So when we finally begin to unlock that capital, we really are going to be in a different world. One of the things that I was impressed with at the White House summit is that for the first time in the room, I saw different types of investors than the traditional group of many of us who've been focused on this. I was sitting next to, for example, the CIO from a major pension fund, who I think was about 80% convinced at that point that there was an opportunity to deploy real capital, and hopefully over this year they'll become 100% convinced. But there really was a little bit of a sea change, particularly at that event, and I could see it happening, but I'd be interested in your take.
Yeah, we're seeing great interest from institutional investors in participating in what we're trying to do. And same type of situation, we are set up as a nonprofit, or we may actually not be able to because we're a registered investment advisor, but we're trying to be a nonprofit, and that's the philosophy. We are hoping that the organization will be owned by our members, so kind of a co-op ownership structure. All this idea of really aligning the interests of those that are helping to manage the money with the underlying asset owners. Because that conflict is pretty profound, and that's something we can talk about. But endowments, pensions are very interested in what we're doing, both because maybe they're trying to do the right thing from a climate perspective. Every university endowment is now having to answer to students and faculty on their universities and colleges about their policies towards carbon mitigation and stranded assets, the type of thing the Vice President was mentioning. So there is interest. What we're finding, though, is it's just hard for these institutions to physically get the money out the door in the right type of investments. And they either have to go through funds, and there are very few large private equity growth funds or infrastructure funds that are focused exclusively in this area of green, right? Green infrastructure funds, which was a very obvious idea, and people have been making money on those type of investments, wind farms, solar farms, water assets. You can make money in that. There are very few dedicated funds that will do that have a fee structure that investors are comfortable with. So that's one large aspect. The other thing that everyone just needs to be aware of, the investing process at a large institution is fundamentally different from the investing process at a venture firm. I mean, venture firm, you have brilliant people running it with staffs, and when there's a deal, it's a very bespoke process to study that deal, and 5 or 6 people will do it, and they'll study it, and they'll make a decision over months. If you're at a large institution, a pension fund, a state pension fund, and you have $50, $60 billion of assets under management, the staff you have to run that is maybe 6 or 7 or 8 people. So there is no time to make an investment decision. That is why investment decisions are handed off to outside managers, or that's why products have to be created which investors can invest in. So the real estate industry, also a very tricky industry, institutional money started to flow into it once real estate investment trusts, or REITs, were created. It's a new financial product that allowed institutions to participate. Oil and gas industry, very hard to invest until MLPs were created. Institutional cash flooded in. So one of the things we're trying to do, and I think this is an area where the Department of Energy, particularly with the labs and some of the work at NREL, can be very helpful, is thinking about what is the right financial product that we create for investing in solar and wind and energy efficiency.
Right.
It's a REIT, it's an LLP, I don't know, we have to create it. But what is an investable product that everybody can understand, and then it's traded and valued, and you can put hedges against it, and all the things you need to do.
So let me...
Can I jump in here?
Sure, please.
And I understand the money is coming in the late stage. So one of the concerns I have being interested in this area is it is very difficult to have the early stage investment, and that's where the model needs to evolve. Why it is financially interesting for financial VCs to come in. There are lots of interest from family offices, which is excellent. The government has its role. The corporates are doing a lot. But you still need that part where you are forming that company, bringing and de-risking the technology so that the corporate can come in, and during deployment, you can put that $100 million in effect.
Right.
And that part is where I think a major gap I'm seeing happening. So in a few years' time, you may not have a pipeline where you need to put that $100 million.
So let me ask you, see if I can combine a couple of your questions. Some questions have come in asking how investments in the energy sector are different from the consumer tech investments. Another comment here from you all that developing energy technologies is very capital intensive. So this is really one of the issues. I mean, energy is a little different than other sectors. It is very capital intensive. It's commodity based in many areas. You have long development cycles. I mentioned that in many cases utilities are the customers, and there's a whole set of issues there. For those that don't grow up in the regulatory environment, the regulatory aspects of investing in energy can be a bit daunting. So, Mike, I'd be interested in actually any of your perspectives on this particular aspect of it, because learning more about the industry, the risks, de-risking is one of the things we're trying to work with investors on. But I'd be interested in your perspectives on that.
I think that was, if you hadn't raised that, I was going to raise it. I mean, we are in a difficult situation, right? We're trying to build companies that often, not all the companies that we're talking about, require a significant capital investment. The core technologies, which many are material-based or science-based or chemistry-based, which is, I'm a chemical engineer and material scientist, which is again why I'm in this space, because I can relate to how long it takes to nurture these technologies and get them from the lab to the pilot to the final big scale, which is where they often drop out. We've got that problem facing us, and at the end of the day, we're making a commodity. So what's happened in the biofuel space, for example, right? Most of those companies are pivoting to higher value chemicals and plastics, pharmaceuticals, food products, et cetera, because making fuel today is not necessarily a high value proposition. So we have a lot of wind in our face, if you will. Mm-hmm. And I would love I completely agree with your investment vehicle, by the way, if we could find an investment vehicle. But to Pulakesh's point, how do we apply that to early stage? How do we apply that to this high risk, early stage, lots of technology risk, where it's not yet proven, like a REIT, or where you can actually see where the money's being made? It's not, the commercial viability is not yet proven. This is a huge vacuum, and all I can say is that's why I jumped into it, because I see the need, I see the huge opportunity, and I think it's going to be in the materials and science breakthroughs that are the core to making these commodities deliver their promise efficiently. Yeah. And it's going to be, and that core, that technology that delivers that will have value. Yeah. And it will generate the returns.
And what I'll add to that is, I think there is an understanding now that the build, own, and operate model in this space, being VC investment, is not the best model. It's too much capital. So you have to look.
Explain a little bit what you mean by that.
Means a couple of the other startup companies, when they started, they said, we'll develop the technology, we'll build the plant. Just to give an approximate idea, a chemical plant is $200 million to $300 million in investment. And then work in the whole supply chain and operate that. Those will take billions of dollars. And that model, being a VC investment company, in my opinion, is not the best model. So you have to work in this space with the other big, and that's incumbent, and that's your channel to market. Mm-hmm. So in some respect, you have to see from the beginning, you have to keep the mind, where is the exit, what's your end goal, And finally, it's not about green or any of those things. Sustainability is definitely there, but you cannot hype your way into sustainability.
Yeah.
The fundamental economics needs to work. And that gating factor and check factors has to happen as early as possible. I said, does it make economic viability? If it doesn't, stop the project. Just because you're making CO2 to some chemical doesn't mean it can sell in the market. The economics needs to be there.
So let me ask you, several of you have asked, there are obviously entrepreneurs out in the audience and looking at approaching you, how you all approach your due diligence, for example, would be interesting to know. One person said, as an investor, do you feel hesitant when a young researcher approaches you with an idea? So it would be interesting to personalize a little bit. And I know from experience, and you talked about 100 investments, which I think is the good news. And so we always talked about having an investment funnel. You start at the top, and then you work your way down. And if you get a couple of investments per year out of that that you can make, you're doing a good job, et cetera. So I'd be interested in all of your perspectives on this, and maybe offer some advice to folks out there that would like to be able to get you to look at their investments.
I was that young researcher 25 years ago. I'm not the young researcher these days. I still feel young, but so I love talking to young researchers. I love the energy, the ideas. As I mentioned, we've looked at over 100 deals, and every one of them to me has been interesting from some dimension, and the people behind it are interesting. They're passionate, they're smart, and they're trying to change the world. I mean, there's no more exciting place to be, in my opinion. So that's who we embrace as a fund, is that ecosystem.
No, I agree with Mike, and that's basically what our job is, to look at that. Though we try to invest in Series B where there is a prototype, we like to interact as early as possible and give a feedback. It's what is actually valuable to us. Because a lot of the time when you're starting as an early researcher, you have an idea, but what we try to bring to the table is what does the market need, where is the pain point. So absolutely, we love to interact.
Yeah. Peter, how are you thinking as you're looking at this and building deal flow? And
I love the enthusiasm, but I'd be happy to have them talk to other people on the stage. No,
This is the market reality speaking right here. It's good to hear.
It's just hard, and the reason energy is hard because it's brutally capital intensive. That's why it's different than software, and that's the mistake a lot of investors made early on, thinking it was the same. You put $1 million into a company and it's going to explode, and that just did not work ever.
And that will not work in the future.
And it won't work anywhere. So it's huge capitally intensive, and how do you make it work? And it's true, we're working on the back end of the system, so that's kind of other products that works. And everywhere along the chain, there are kind of valleys of death. We're trying to figure out now ways that we can catalyze the billions of dollars from conservative institutions that need to have safe returns, 8 to 12% IRRs, happy but sustainable, very little risk of loss, and that's a very nice way for them to invest, and they're not doing it now. They're not finding vehicles. So that's our mission there. But all along the way, the LPO, if we can just talk about that for a second, that was so important because it was for companies that had gone through the process. Little post-VC, they raised some money, they had a pilot plant, it was a good technology, maybe they came out of ARPA-E. But then they said, okay, we need to get this thing built. And they found an equity investor who would put in $50 or $100 million to build it, and it was to build a facility. But those facilities cost $1 billion. So where could you raise the $800, $900 million to build that first utility-scale solar plant, the first huge wind farms, the first cellulosic ethanol facility, a big facility, not a pilot plant, $250 million facility. So what the loan program office did in the Department of Energy, they gave a guaranteed loan for up to 80% of the cost. So the government guaranteed the loan, and the government did that solely to catalyze the private money that would come in, to encourage the private money to come in, build the first, they could actually build the first three of the facilities, because by then there's enough data. Other investors and lenders would see if the technologies work, and then it went off to the races. So the Department of Energy financed the first 5 utility-scale solar farms in the United States. Everybody thinks solar is such an easy and investable commodity now, but these developers could not raise money to build utility-scale solar facilities, even if they had a 20-year offtake with a utility, a single A-rated utility. Even if a developer was putting in a couple of $100 million, they could not raise debt financing, This is 2010 and 2011, not ancient history. So the Department of Energy financed the first 5, and then it was the stimulus era money, so that funding stopped in 2011. And since then, 28 utility-scale solar facilities exist, and they're financed very easily by institutional investors and lenders. So that's an incredibly important catalytic role that the government does. Just one last thing I said, John, it's all about risk and how you mitigate risk. And we're trying to do things on the back end. The front end piece is where it's so hard. And venture capitalists or angel investors have to earn 30% on their returns because 6 of them go bust, as the vice president said. So I think what we need to find is, and this I'd be interested, John, on your thinking on this. We read about all this new money coming into the sector, and the Department of Energy has gotten so involved with Bill Gates and that whole initiative. So there's that. Their foundations are getting increasingly interested. It'd be great to find a product, which is essentially a first loss product or a PRI type of product, because venture capital shouldn't have to take all that risk on its own. That's what's needed.
Yeah.
So if the government created security or working, something like
Well,
that.
Can I add one more,
Please,
just
feel free.
to build on your model, which that was an excellent description of how you build out, demonstrate, and then let the markets take it over from there. So we didn't have government-backed financing, and I was building tens of millions of dollar plants. I built 3 world-scale plants around the world. So what we did, just another idea out there, I'm not going to say it's the best idea, but it builds on something Pulakesh said earlier as well, is we found partners that were interested in our technology that understood the commercialization of that technology, and we joint ventured with them. And so we only had to put in roughly, on average, 10% of the equity to build a very expensive plant, yet we still own the majority of the plant because we brought the technology. And we got partners that understood that, yeah, we were making it happen. We were the keys to the success. And we were able to use their balance sheet to raise traditional debt because we didn't have the government debt back then. So we used partners in 2 ways, both to provide the additional equity and to use their debt-raising capacities. And I think that's partly what you were saying, find partners that know how to commercialize this technology.
And bring it to the market.
And bring it to the market, both from they know how to bring it to the market standpoint, but they also have the balance sheet and the cash that can fill that gap.
But Mike, what you're not mentioning is for that to happen, the basic economics has to work. These partners can look at your technology, validate it. A lot of the things that did not work in the space is because the basic economics did not work.
So you have to there's multiple valleys of death. And there's usually talked about the one valley of death, the big one going commercialization, but to me, there's the first valley of death, getting that first pilot scale, which if it doesn't demonstrate commercial viability, you can trust that it's there.
Let me try to get a couple more questions. We're going to run out of time here. But first, to address your question, Peter, just put something out there for people to think about. One of the things that I personally have been trying to think about is, are there ways to create different capital structures in investments of this type? Are there different strips, if you will? Are there types of investors? There are very few investors who knowingly want to lose money. There are some investors who are able to make very risky investments because they believe they're socially productive. They recognize that a return of some of their capital might be acceptable because they are purposely trying to incent things that they feel are socially productive. And I think that's absolutely fantastic that there are folks that are willing to do this. Are there ways to build them into capital structures? That was your first loss kind of idea. If we think of strips, all the way from that type of investor to a more traditional VC investor to, say, a university, are there ways to build capital structures that might get us through this first valley of death? So that's something to think about. One question here was what the role, if any, how do we feel about the role of utilities investing in clean energy? We were talking before we all got up here a little bit about analogies to the biotech industry, and we were having a lively debate about whether those analogies have merit. My own experience back in the late 70s, where I was working I was actually an attorney at that point, and I was working on the first stage of what were called R&D partnerships for biotech firms. So Genentech, when they went out and raised their first $20 million and that type of thing, when they were really looking at their very early stage capital. And then you saw several decades of investors coming in, a lot of investors losing money, but companies and technologies maturing, and then the inevitable industry consolidation. So, and I think Pulakesh would rightly point out there are big differences between biotech industry and the energy industry, but you do have the maturing of technologies, costs coming down, but most importantly, you then saw the consolidation, and basically big pharma came in and bought up most of the biotech. So I wonder here, and I'd be interested in your perspectives. We used to talk about alternative energy, but there's no alternative energy anymore. It's energy, it's clean energy. What is the role for, will we see this kind of consolidation, and will that be a positive thing, or are there barriers still? Maybe Mike, maybe you want to take that, and then Pulakesh. Sure.
I think it's a natural evolution of any industry to see a build up, and the first companies are the ones that get the arrows in the back, as we all know, right? So that they do the heavy lifting, and some of them come out the other side and some don't, and we all learn from that, and thank goodness they do it, and thank goodness investors have allowed that to happen. So I think this build up and crashing, if you will, of different industry sectors is normal, and it's not pleasant if you're one of the ones on the downside, I can tell you, but it's inevitable. So yes, the short answer is it will happen. I just want to throw something out there, though, that we haven't talked about.
Because we're going to have to wrap up here in a couple
and it relates to government role. And there was a Guardian article written about me. Can a libertarian be an environmentalist? Now, I don't call myself a libertarian, but I'm a free market guy. I am. But I'm also an advocate for the environment. I walk the talk every moment of my life. I think the two are extremely compatible. So let me say, how does that play out in this space? I think there is no more powerful force on the face of the planet than the free market system and a business allowed to be efficient. Look what it's done. Look at the quality of life it's delivered. Look at the downside it's delivered, right? It's extremely powerful. One of the problems we're suffering from is garbage in, garbage out. So if we think it's free to put carbon in the atmosphere, if we think there is no price on carbon, we will get companies behaving like that's free and that there is no consequence. A company with good information coming in will solve our problems faster than any other force on the planet. So let's figure out how to get the information right. Let's figure out how to get the accounting right. Let's figure out how to get the costing right. And I think everything else will take care of itself. These companies will be off to the races.
So we're gonna have to leave it there. I apologize.
Sorry.
The reason I know that, is they have wiped my screen clear of all of your other questions, so I can't ask any more questions. Let me just finish by saying that we really appreciate everybody coming and taking the time. We could obviously spend all day long debating about this.
Agreed.
Again, speaking personally, I really do believe that we're at an inflection point. It hit home to me a couple months ago. I led the U.S. delegation over to Ispra, Italy, which was tough duty, to help inaugurate the Electric Vehicle Smart Grid Interoperability Center for the European Union. We have a companion facility at Argonne. And I must say, spending the day there and really realizing how electric vehicles are about to change the world that we live in, and seeing the good work that governments are doing with private industry and trying to create these standards. I think sometimes that people in the investment community, certainly from the investment community that I came from, they don't fully understand yet how close we are in a lot of these technologies. And I think there are enormous opportunities for investors who take the time to really understand that. And I know in particular that out in the Bay Area, you can feel it. It's very exciting. When I travel to Wall Street, I feel like that they're figuring it out, but maybe one half a step behind. And I think there are going to be wonderful opportunities for those who really do understand. And hopefully at the Department of Energy, we can help through the Clean Energy Investment Center and elsewhere to provide more information to help de-risk some of these technologies and make it possible to come up with investments. But thank you very much, and please join me in giving our panelists a round of applause.